Hey, thanks, Aditya. Just for the audience, first, I think good things come to those who wait. So, since you have waited for 2 days for this session, so this is the best session of the conference. So, for people who are waiting, it's really worth your while. Just to make it a little more relatable for people to understand Holden family and what their legacy has been. So, just for the Indian audience, they are like the Tatas of Quebec. So the way we have a Tata family in India, who have been the pioneers in business in India. Similarly, the family has really led a lot of businesses in Canada, and they're really established institutions in Canada, banks there. So they are the ones I think who kind of envisioned, who kind of created the demand for family offices. I can say, I think if I won't be wrong if I would say that Holden would maybe might just be the oldest family office in the world. Uh, if I may not be very wrong in saying that. So there's a lot to learn. I will not take too much time today. I will let Brendan speak a lot and kind of share his experience of himself, of taking over a legacy, and also I think he also brings a richness of experience in kind of looking at the customer experience changing over the decades and years. So I think so. We'll ask Brendan to share his success mantras for really creating a sustainable 100-year-old family office. What are the key success tips that you would want to share with our family office managers in India?
Oh, thank you for that. I appreciate you having me. Do you want me to jump into it?
Yep. Please.
I guess. Well, I guess.
So my first question to you.
Go ahead, please.
Sorry, I don't know if. No, my question to you was, I mean, I went on to the success mantra, right? To run an enterprise, a family office for so many decades.
Yeah.
What do you think has really driven the success?
Yeah, I was actually talking to my father about this yesterday, and he does apologize. He's unable to make it. If he wakes up relatively soon, he'll definitely join. I think on the success mantras, I think what we kind of came up with is it's at the end. I'll tell you the kind of the unifying theme, but you have like open and transparent governance, trust, honest communication, and then obviously I think one of the main things would be education and involvement of younger generations, either our own family or our clients, right? But if you kind of look at all of those, it really revolves around how you would want to be treated. And it revolves around open and honest communication, even the good times and the bad times. I've seen a lot, like, obviously we get a lot of information or hedge funds or any type of financial service product pitching us on a regular basis. And when times are good, they're very, very active in making sure you're aware of how good their performance is. But if something goes wrong, you don't hear from them for months. And that's really the worst thing you can do. No one's perfect. They're going to have ups and downs in the markets. And I think the most important thing is that continuing that conversation, that communication in the bad times. Radio silence during that and trying to like hide in your shell is the worst thing you can do, because all it is going to deteriorate any trust you built out with your clients. But first and foremost is really just treating your clients like I would expect to be treated. And that's open communication, regular communication and contact, and involvement and participation. So working with the client, which could be one of my family members or another family, working with them to understand their needs and their requirements and making sure we're both aligned with how we want to manage their portfolio on a ongoing or go forward basis. And then finally, as I mentioned, is really our view of wealth management is a generational view, right? So we're not here to manage money for 5 years or 10 years. We're here to facilitate the tax planning, estate transfer of wealth into the next generation and the next generation, the next generation. So in order to make sure the next generation is prepared to accept that responsibility of having that wealth, they need to be involved, they need to be educated and prepared. So those are all the things that we think are really important. So that just revolves around making sure you're in communication, you're in contact with the client, regardless who it is.
Got it. So one of the important aspects about running a family office, I mean, not the challenge, this really manages intergenerational shift, right? So you may be great with the father, but the son thinks that you are old school. I know you are not really cared for the next. Since you have been really running a family office for decades, I understand that education is an important part, but how do you really manage this continuation of trust and relevance, even for the younger guys? How do you do that?
Yeah, no, it's interesting. And again, it might segue into our future conversations, what we're talking about. But, I agree with you. We've been lucky, obviously, that my grandfather ran it, my father ran it, and now I'm running it alongside with my father still as chairman. That the relationships we have from our existing clients. My father was friends with his age group, and I'm taking over the responsibility of communicating with my age group. So there's been a very seamless transition. So it's not like my father's still running it and talking to 30-year-olds. That would cause the issue you mentioned, like, oh, he's too old school, or he doesn't know what I want to do, or he doesn't understand technology. Many reasons why a 30-year-old would not want to be talking to a 60 or 70-year-old. But we've been fortunate that we've been able to maintain those relationships with the two levels of generations, my father's generation and my generation. But it does segue into the younger generation, the people that I'm dealing with that are taking over control from their family, are looking at being more involved. They are also looking at, they have other requirements or needs, whether it's social investing, whether it's more technology or the crypto, Bitcoin, all that stuff. It's really having the ability to provide that guidance for them, compared to the older generation, which was more the standard portfolio was stocks and bonds. So you have to make sure that your ability to adapt to the market, but not also just get in there because you think it's important. Like, it doesn't necessarily mean we're pro or against Bitcoin, but we need to have the understanding and the ability to speak about it intelligently and explain to a client why this does not make sense for a portfolio.
No, that makes sense. And allow me to just digress a little, because the one question I got really curious about, uh, since you said your grandfather did it, then your father took over, and now you are taking it forward, then there has to be very fundamental purpose of running a company. Because if you start a company, it's very difficult to excite your son to really run that same company. So there has to be so if I may ask, what's the purpose as you see of the Holdun family office?
Well, it's twofold, right? We have to look at it, as you said earlier, as a business, but also as a client, right? So we're a real multifamily office. So our family is our anchor client, right? We were a single family office for 4 generations. Now we're a multifamily office. So we are the original client. So as the client part of it, just like we say for all of our other clients, it's the transfer of wealth, the intergenerational transfer of wealth, right? So for us, just like we say for our clients, we're looking at how to balance and manage a portfolio and transfer that down to the next generation and the generation afterwards. So, I was educated at an early age because I expressed an interest and a desire to be in this space. My brother did not, and he's a lawyer and fully respect what he does. And my dad did not force me into this, but when he saw that kind of passion or desire, I started getting the education that I required to be involved in that. And that kind of segues into the business side of it. Is I did have a passion for this. I like what we're doing. My children are too small, too young to even discuss this with them. So I don't know what's going to happen in 20 or 30 years. But it's really, I think if you force your child into this, I don't think it would be as successful as it is, simply because they're in a job that they don't want to be in. I'm one of 16 children in my generation, not my father, but it's myself and my brother and 14 cousins, all of whom had the ability to be involved in this, none of whom expressed an interest or desire to be in the financial space. So it didn't fall to me, but I'm not the oldest. I'm in the middle of the pack. So there's many people above me that had the opportunity, but I was the one that wanted to do this. So that was where the focus lay, because, I think this would not continue as it was if I was not interested in doing this, in a sense. So you have to make sure that you're not pushing a family member into something they don't want to do. At the end of the day, it's still a job, and no one's going to be as productive or as efficient in a job that they don't want to be in.
Completely agree. And thanks for sharing a little more personal side of your story. But let me just come back to now the next generation. You touched upon how the new generation really is looking into crypto and other things. There's also now technology coming as in terms of delivering experience to clients. I see that you have a Holt accelerator. You are kind of very passionate about bringing technology to the financial world. So if you can just lay out, and that's really be beneficial for all of us, because a lot of family offices run like boutique firms, person driven, relationship driven. Technology sometimes take a backseat. But how do you see technology now playing a role, especially things like AI and other like blockchain, which are not just a website or just not at that level, but they are kind of going into creating the allocations, creating portfolios. How do you see all these technologies now playing a part or role in building a family office?
It's interesting, and there's a multifaceted answer to that. So I'll give you the background first of the Holt Accelerator for people. Um, so our background, it was actually my great grandfather, not my great grandfather. So Sir Herbert Holt was my great grandfather, and he was extremely successful, as you mentioned, in the Canadian ecosystem and industry. You mentioned Hydro Quebec, but another thing that he was probably more well known for. He was the longest serving president and chairman of the Royal Bank of Canada for 35 years. So I think we've always been in the finance space. Hydro Quebec, or it was when he owned it, it was Montreal Light Heat and Power, and the government took it from us or nationalized it. But now known as Hydro Quebec, that was in the energy space. But our background, our history has always been in the finance space as well. And as a multifamily office, when we were doing more and more, allocation, not in terms of percentage, but as you get more capital and as the portfolio shift into a more well-balanced allocation, including multiple asset classes, we're having more allocations or looking more at venture capital and private equity. And we started to realize when we were doing due diligence, especially on the venture side, when it came to fintech investments, we believed we understood it really, really well. That's our background, the finance space. From a client perspective, because we could see, hey, this makes sense for us, but also from an investment perspective, the potential need for this. Excuse me. So at that point, we started to think, well, we can be extremely active and value-add investors when it comes to fintech investments. Anything outside of the fintech space, let's say real estate or whatever type of asset class other than that, we're never going to be the lead investor. We'll be a passive follow-on investor with one of our other family office partners that has expertise in that sector or industry. But we believe that we were an expert in the fintech space, and be able to do really good due diligence on those investments. Then on top of that, given our family's history, reputation, and background, and our network, we could be extremely value-add investors by opening up doors to those startups, whether it be the CEOs of banks or venture capital funds or etc. So we believe that we could be very, very good partners and active partners in those fintechs. So we're still entrepreneurs by nature. So it's a long story to make it short. We decided to create our own fintech accelerator. So we have that now, the Holt Accelerator. It's a separate standalone company, but what it does is it scours the world on an annual basis, and it gets last year it got 800 applications from 75 countries, and we picked 8 companies from I think 4 countries that were in our cohort this year. And we do that every single year, and they're only fintech companies. We're now known as the most active fintech investor in Canada. So that's the background. Now, kind of answering your question is twofold. The technology is 2 parts. You're looking at it from the ability to run our business better, and separately from potential investments, right? So if we look at the investment side, you mentioned AI. One of the companies that was in the accelerator this year is using AI to build portfolios. It's basically a quant trading strategy using AI-driven algorithms to focus on. Right now, is only focusing on 4 or 5 ETFs in the States, the most liquid ones, to build his portfolio. So we understand that the world is kind of shifting to that. Sorry. We haven't seen proof that it can outperform on the long run, a good portfolio manager, but we realize the need to explore that industry. So what we always do is when we're recommending a new or looking at a new possible investment or opportunity, our family always goes first. So we're not going to put our clients' money in before ours. We're going to test it out. We're going to take the risk. So with this company, we were the seed investor. We gave them some money to build out their technology, and we gave them a small amount of money to actually manage on the portfolio side using their AI-driven technology, so we can build a track record. And if that track record is successful, then we can help them grow, whether it's creating a fund or then looking at whether it makes sense to deploy client capital into there. But that's what we're doing on the investment side. Is we do realize there is things in the crypto space, or is things in the AI space that you need to start looking at and doing your due diligence on to see if it makes sense for a client's portfolio. And if something does merit looking at, we'll always take the risk first, just like we did with this AI-driven trading platform. Kind of pivoting to the technology requirements as a business. So we're not a fintech, but we're in the finance space. So one of the other added benefits of having our own fintech accelerator is finding technology that can benefit our business. And then we have done that. So we have adapted or adopted technology from the accelerator into our own business. You know, right now, I know one of the questions, Siddhant, you sent me, and maybe I'm jumping ahead, is, you know, if you're going to build a family office now, what would you differently? And I think you would embrace technology more in terms of more of the back office side. So still right now, any kind of wealth management, whether it's us or opening up an account at a bank or having a third-party asset manager for the ultra high net worth individuals, is still a very manual process involving paperwork, scanning your passport, certifying all that. It's not efficient, and it's very cumbersome. But there is technology that exists out there now with, you know, real-time AML, KYC, onboarding, and all those things. So we're, you know, those are things you can really cut your costs down and make it more efficient for yourself and a better user experience for the client. So we are looking at technology for that. We're actually just engaged a company to help us transform our client onboarding process into a digital format for our clients. And it benefits them and it benefits us. Everything's obviously stored electronically. It's safe and secure, but it's a lot easier process for the client. They can do it at home with the click of a button. But technology has definitely increased rapidly, and you have to look at that in terms of what it can do to benefit your operations, as well as increase or benefit the experience of the client himself.
That's
I
great.
hope I know I went everywhere on that question. So
No, I think
okay.
you kind of covered in terms of that. You should not look at technology as a threat. You should look more technology as an enabler now to kind of be more efficient and focus your time in things that really matter, building the relationship and giving advice. And the back office can be outsourced to technology. I mean, that's relevant.
Yeah, and sorry, we're still looking, just to go back, we're obviously looking at other investments. I know there's blockchain and crypto and all that. And I think we're somewhat unique in that, is that we have this fintech accelerator kind of screen all of those investments for us. So we have one of the companies in the accelerator is in the crypto space. They're like a passive crypto ETF. There are other companies that are looking to be like the Bloomberg of crypto. So we get that exposure through our accelerator. And, you know, we're looking at 800 companies a year, the accelerator is, and we're picking the top 8, you know, and we have themes every year. So this year's theme might be more focused on digital and crypto space as it's evolving more, but we have a little bit of a more unique access into doing the due diligence on that, because we have an entire company that kind of does it. And then we look at the ones that make it into the accelerator and whether we want to invest in those companies for our clients, or if it makes sense to add to portfolios. But I do think that, you know, blockchain, crypto, it is at a stage now where you have to address it and look at it and see if the risk reward meets your kind of investment thesis. It's not for everyone. It's not going to be for, you know, but I don't think it's going to disappear. But it's definitely extremely volatile right now, and there is additional risks to it. But it is something that you need to at least have on your radar at this point.
Yeah, no, I agree. BlackRock has now really made an announcement to include crypto on the iShares platform, and I think some form. So I think that's a big move by the world's largest wealth manager. So I think that's a big endorsement for crypto. It's here to stay. So thanks on that. One important aspect I really wanted to share, I think, is benefit is on the product side. So one part is the relationship, technology is one side. What kind of products have you innovated that have really, really delighted your clients or met their needs over the years? And if you can just share your flagship ideas with us, that'd be great.
Yeah, no, it's interesting. I appreciate that. So, you know, kind of referencing what I mentioned in the past or earlier, is like we're always first capital in, we always take the risk, right? But we're also, on top of that, we're our original client. So it's as any multifamily office, it's that, you know, it's that kind of the shared inherent kind of risk. We're in this together in a sense, right? So where our money goes, our client goes. So it's the alignment of interest. We're not an independent asset manager that has no skin in the game, right? So an independent asset manager might buy 10 million shares of Apple and it might go down. He's not really at risk for his personal wealth. His bonus might go down, but it's the client that's taking the hit on their kind of their net worth. But as a multifamily office, if it's run properly, we should be doing this together, right? So if I'm buying 10 million shares of Apple for you, Siddhant, then I should be doing that for my family. Else there's some reason, there's a red flag there. Why aren't you buying it? Why am I buying it for myself if I'm recommending it for you? So we're always making sure that we're always aligned with our clients. And the best way to do that is always be the first capital in. So, back in about 2008, 2009, when the first crash happened, we still at that point had 3 generations of family that were managed, internally, that we're managing portfolios for. My grandparents were still alive at that point. And then there's my parents' generation and his brothers and sisters, and then my generation. And there's a huge demand from the older generation, as always, was for income or for yield. And there wasn't really much yield out there at that point. So that's just an example of, at that point, we realized that how can we get, decent yield without taking on additional risk. And we spent years doing research and realized that there is a demand from our clients on this. And we ended up creating our own fund to solve that need. Not because, and this is the first time we ever created a fund structure. We're not in it to create a fund structure to make additional management fees. The fund structure was the best way to allow any one of our clients to invest in that product for any amount that they desired. So all the things that we've created, like our income fund versus the other things that we've built out, it's been out of a demand from our clients. So it's a demand-driven and client-driven requirement, not us trying to create products to make money out of them. It's really where can any one of our clients' portfolios, including our family, be better, or where are we missing some of like alpha that could create a better, more efficient, diversified portfolio, and overall the portfolio lower the risk. So we have created a few products out of that. So we have our income fund. We have something that was unique that came to us, is a sports betting fund. Or not, we created a sports betting fund, but we have a friend that has been in well, we call it soccer, I assume you guys call it football, in the football space for decades. And he, going back to technology, he ended up actually creating a mathematical algorithm that bets on football matches. And it originally bet on the top 5 European football leagues: England, France, Spain, Italy, and Germany. And he'd been doing this for like 5 or 6 years at that point, and he's had an average return of about 27% a year. Because any type of sports betting is inherently inefficient, because most people use their emotions to bet, right? Like I'm a hockey fan, right? So, and I'm originally from Montreal. So if the Montreal team is playing the Toronto team, I'm going to put my money on the Montreal team, regardless if they're going to lose. Like, I'm never going to bet for my rival. So that's what happens again in football. And there's a lot more money gambled on the football matches around the world. So he's basically taken the motion out of that and used math and science to realize, okay, every given year we're going to win about 60% of our bets. And he has a track record of about 15 years now of winning 60% of your bets. If you're winning 60% of your bets on an annual basis, you're making money. So we then decided, again, our family first, put a small amount of money with him personally to test it out for a year, and also to build out a track record, and help him show how to state his returns on a monthly basis. What due diligence did we need? What kind of information did we need on a monthly basis to validate and verify his returns? And we helped him with that for a year with our family's capital. We tested it out, we saw the returns, and we realized this was something worth it. It's obviously a little bit less liquid than being in shares of a stock or something, but it's a good diversifier. And then we would then show it to our clients after doing our research and our due diligence, putting our risk capital in, and say, hey, we've put our money into this. It is inherently different. We've created a fund structure, but since it's an internal fund, we believe, even though we have discretionary control, it's still a conflict of interest. So we want to work with you to decide whether you think it's a good investment or not. At the end of the day, it's the client's decision, because we never want to have that conflict of interest where it seems like we're taking a client's money and putting it into one of our own funds for our own benefit. At the end of the day, we have about 65 million in there in the last 3 years for our clients. It's not a large amount of capital for a family office, but we're also not trying to chase home runs. We realize it's illiquid, it's only annual liquidity. And and it is still inherently risky. So it's only like a small fraction of a client's portfolio that we would allocate to that if the client agreed to it. So that's the other thing we've kind of built. Again, it's something that we found that's unique in the market that benefited our clients, but we're gonna test it out first ourselves. The other things we've done is we've kind of gotten more into the real estate side, not just for like our own personal real estate or our clients' real estate, but as a good investment allocation. So going back to the theme about social impact and social investing, we've created a product that invests or buys medical recovery centers in the southern US, which is a very big business, but it is a social impact. We're helping lots of people recover from drug addiction. But from a business standpoint, it's a very good return on your investment, owning medical recovery centers. And then we've just about to close this week or early next week, actually, on about $200 million of real estate in Boca Raton, Florida, which is a very high-end area. And we've created 2 separate funds for that for our clients to invest in. So we're always, at the end of the day, we're always looking at opportunities. We're still entrepreneurs. The accelerator itself was an opportunity that we created. Our family put money into that. And then we showed it to our clients saying, hey, we're creating a new company. Anything that we do, we offer to our clients. So we created the Holt FinTech Accelerator. We put our family's capital in it. It's like, this is pretty much, you're basically investing in a venture capital fund, but you're going to own the venture capital fund. So you're going to be, you're not going to expect a return for 5 to 10 years on this. But if you're interested we're happy to let you come in and invest at the same terms that we did. So those are the kind of things we're doing. We have real estate. We have the alternative investments, whether it be sports gaming or real estate, as I mentioned, and our VC fund, the accelerator, because from that VC fund, we're able to invest in any of the companies afterwards. So it's kind of like our screening tool to double down on more fintech investments. And we'll continue to look at opportunities. Everyone sees deal flow on a regular basis. It's all unique, but when we see something that piques our interest, we'll spend the time and the resources to do due diligence. We'll then spend the time to put our own capital at risk. And then once we're comfortable with it, we'll then open it up and recommend it to our clients. Not even recommend it, we'll show it to our clients and let them make the decision on their own, and inform them, this is how much money we have in it, and this is why we believe that you should do it.
Yeah, I'm personally, your sports idea really personally appeals to me. Just tempted to ask on behalf of the audience, can they approach you directly and invest their clients' money in these strategies? Can people do that?
Yeah,
can they
of course. Anyone. I'd love to speak. I always love meeting other people, and we're always looking to work with other like-minded individuals. So anyone happy to, I assume you could share my contact info. I don't know if it's me, I froze or you froze. Are you still there? Can you hear me?
Sure.
Okay. Yeah, please share my information. Happy to talk to anyone and show them anything they're interested in looking at.
Yeah, I think you can post that on the chat window. I think for everyone to see your contact details. So people want to contact the office, that'll be great for them to get a piece of this. I will open the session for Q&A before we close it, but I think there are a couple of questions that still come to your mind for people. This is, I think we have understood the world, we understood your products, we understood the technology. Really want to get your opinion on the post-COVID world, right? What everybody's saying that this is now a different era. Do you believe so? Do you think it's going to be the same? What's
I wish I had the perfect answer, right? Because then I'd be the first trillionaire. But it's actually interesting. I was speaking to my friend at Scotiabank, one of the largest Canadian banks, 2 days ago actually, and he's pretty high up, senior executive vice president there, and he's saying that they don't expect to go back to the office until spring 2022. So, and I was questioning that, because there's the delays in the vaccinations and all that. I understand that, but he just said, for these giant companies, they're always scared of lawsuits. The last thing they want is a class action lawsuit from employees saying they were forced back to work, or they're forced back to go to an unsafe environment. So for them, they would rather prefer saying everyone work from home for another year and a half. So the vaccine, I don't know where it's going everywhere in the world. I know the US is having delays. Canada's even worse, having delays. Bahamas hasn't even got the vaccines yet. So I don't think there's going to be any type of start of a return to normal until at least September of this year. But I think, especially in Canada, which are obviously a lot more conservative, I think the large banks aren't going to have anyone back in until 2022. So you're still going to have this. And what does that create? It creates a lot of inefficiencies. Like I was talking to my other friend who works at TD Bank, and he's up there as well, and he's at home. But in Ontario, the schools are off. So he's got 2 kids online schooling at home, and him and his wife, who both work at TD, they're trying to work full-time jobs while their kids are at home, right? So it's going to be very strange for a while. As I was talking earlier, we're blessed in Bahamas that we're pretty normal. So I'm at the office. Jermaine, who works with me, he just showed up. He's late, so he's in trouble. He's here. Our kids are at school. So we really haven't seen the impact. But the other, so it's I can't answer. I think post-COVID world is going to be different, and I think it's people aren't going to be comfortable until the vast majority of the population has been vaccinated. But I do think, and I heard this from a lot of people, is once the world kind of opens up again, I think a lot of people are going to spend a lot of money in the first year or two, because they've been locked in their house. They haven't been able to travel. They haven't been doing anything. I think people are going to want to get out there and go travel, do the things they've missed in the last 2 years. So I think you're going to have a lot of spending occurring in the first year or two, after kind of all those restrictions lift.
Got it. So there's one aspect that has been really, really pertinent, comes in a lot of conversations, is that what has happened in the post, because of COVID, is that people realize that they can't be dependent on one country, right? People are talking about, I can't have my entire supply chain in China.
Mm-hmm.
Automakers in Germany have now been started thinking, let's have something more close by. Now, as the world is getting little more decoupled, they're not really that integrated. How do you see the correlate, like the global diversification proposition, play out now? How do you see the point of that, the regulations between countries? Do you think they're going more stringent, moving money globally? How do you what are the trends that you see?
It's a good question. I can tell you trends more I've seen on the population movement first. Like, so I've seen a lot of people realize, given the fact that currently they can work anywhere from the world now, right? People have realized that remote working works. Again, talking to the head of our Royal Bank of Canada, they've saved over 200 million. Sorry, not Royal Bank. So Bank of America, he runs all the investment banking globally. He's saved in the last 6 months over $100 million in travel expenses. He goes, and our efficiency our working from home has actually gone up. So I think what I've seen is, living here in Bahamas, there's been a huge influx, not a huge, like compared to, there's 300,000 people here, but there's been an influx of people moving here, either for the next year, because they're like, well, if I can work remotely, I'd rather be in Bahamas where I can go outside rather than be in Toronto where it's -30 and I'm locked in my house. And most likely a bunch of those people are going to realize, well, if I can stay here, I'll stay here, right? So there's been a shift of where people are living, because now they realize, hey, I can work from wherever I want. Let's go somewhere I want to be. And again, that's one of the reasons we're buying that property in Boca Raton, because I always get this wrong. I think it's 1,000 people. I think I always say it's 1,000 people a week. That's not possible, but 1,000 people a month are moving from northeastern states of America to Florida, and most specifically Boca Raton, since COVID. So you have this influx of people leaving New York specifically, or Eastern New York, northeastern states, to Florida and focusing on Boca Raton, because either they have wealth and they're retired and they want to be in the sun now, or B, they have wealth and they have high-end jobs, but they can work remotely, and Florida's an open state. So you're having this, and this is what I know. I don't know about India or what's going on with Asia and Europe, but I'm assuming that the people are being more transient and have the ability to move where they want, given the ability to work remotely. In terms of how the governments are doing, I honestly have no clue what's going to happen. But I do think the post-COVID world will be different than what we experienced before. What I can say is definitely on the population shift of where people are moving, but on the government side, I'd be lying to you if I could say I know what's happening there.
So one interesting shift that's happening in India, and I don't know if you see the same trends outside, is that people are now saving more for retirement and health. So initially in India, if you look at the bucket, people would spend money on kids' education more, or kids' marriage for that matter. But now, because of what has happened, Corona, they kind of realize there's a lot more uncertainty now. So they are
Mhm.
putting more money in retirement. Do you see a similar mindset evolving uh, in the segment that you operate, or the people, or the market that you talk to?
Um, for us, like I think we haven't seen any real change. Like for again for us and our clients, you know, to work with us, you have to have the same philosophy, right? So anyone that works with us believes in like this generational wealth management philosophy, or you know, so you know, we didn't panic in March, right? We've also added more money to the equities at what we believe was somewhat near the bottom. So we haven't been seeing people shift into cash. Now that the market's had this very good run, we're being a little bit more conservative where we allocate our portfolios. We always like to be allocated. We don't want to be sitting on 10, 20, 30% in cash unless that's a specific requirement for a client. We're usually around that 5% range. It's just more of where we shift our buckets. um, you know, interesting as you mentioned this. So that's our clients, right? The family offices, the high net worths we work with, and you know, but again, I was talking to my friend at Scotiabank in that same conversation, and he's saying it's crazy right now. It's going in Canada. If you look at the pre-open on the stock market, there's a lot of volatility in the opening of the stock market right now, and then like in that first half hour window. It's because they have the data, right? Because they own the largest trade brokerage platform in Canada as well, so he knows what's happening. It's all these what they would call savers, all these people that are putting their money in the savings accounts, but they're working from home and they're turning into day traders. So all the movement in the market is coming from the savings population of Canada, and they're bidding up these stocks pre-market. And then when the market opens and the institutional players come in, the volatility goes back to where it was. But so I guess there's a lot of people in Canada that are trying to become day traders because they're bored at home. But teach their own. Everyone's different. But I think COVID being locked in your houses and is giving you time to try other things, and it's going to be interesting. But going back to what I said earlier, I do think once people are free to travel around the world again, I think you're going to have a mass movement of people enjoying life again.